Think about the last time you borrowed money, or even just thought about it. A mortgage, a car on finance, a new sofa spread over a year, a credit card. What's the first thing you look at? Usually, it's the interest rate. Is it cheap or is it expensive? That one number feels like the price of the debt, the thing that tells you whether it's a good idea or a bad one. And it does matter. But here's something strange. Two loans can charge you exactly the same rate, and one of them can quietly turn your life upside down while the other barely touches it. So the rate can't be the whole story. To see what a debt really costs you, you have to look past that number, at what a debt actually is. So what is it? Debt is spending money you don't have yet. You're using money you'll only earn in the future, and the interest is the fee for using it early. Two things about that fee catch people out. The first is that if you don't clear it, the interest gets added on to what you already owe, and then you pay interest on that too. It builds on itself. It's the same thing that makes savings grow over the years, except now it's working against you. Say you owe £2,000 on a credit card, and you only ever pay the small minimum they ask for. At a normal card rate, you can pay thousands in interest and still owe well over 1,000 of that original 2,000 years later. The rent on that money just keeps stacking up. The second thing is about time. Spreading the same loan over more years makes each monthly payment smaller, which feels easier. But you pay far more in total, even if the rate never changes, because you're renting the money for longer. Borrow for a car over 5 years instead of 3, and the payment looks kinder, yet you can hand over hundreds more in interest by the end for the very same car. And underneath both of those is the part that matters most. And it's the easiest to miss. Once you've borrowed, that payment is owed every single month, no matter what happens to you. The lender doesn't care what kind of year you're having. That's the trap. When you take a debt on, the payment can feel easy to cover because you look at it against a normal month, one where you're earning and things feel steady. But you're judging it against a good year. The debt still has to be paid in the bad ones, and those are the years you never see coming. And that's the real problem, because something always will happen to you. You've never once woken up sure that nothing would go wrong that day. That's not how life works. Problems aren't a risk, they're a certainty. There's no knowing what they'll be or when they'll come, but they always come. Whether it's losing a job, an illness, a house move you didn't plan for, or just a bad year that drags on. So the surprise was never that trouble shows up. The mistake is being caught out by it, as if it wasn't always going to. You can't stop the shock from coming. What you can do is keep enough room to take it. A bit of money set aside and not too much owed. Then you can meet it with a clear head and a plan, instead of a rushed decision made while you're frightened. But that room does more than help you handle a shock. It makes the shock smaller. When you don't owe much and you've got a little put by, the same bad news lands far softer because you already know you'll cope. Debt does the opposite. Every payment you lock in takes some of that room away. It turns a bump you could have absorbed into a real problem. You can see how that works the moment money gets tight. Most of your costs can bend. If you need to, you can eat out less, cancel a few things, put off the holiday, shop cheaper, and wait for better days. There's give in them. But a debt payment doesn't bend. It's fixed. It turns up on the same day for the same amount, whether you just got a pay rise or just lost your job. The month the boiler dies, the car needs work, and your hours get cut, every other cost gives you a little room to breathe. The debt gives you none. It wants the same amount on the same day as if nothing had happened. So the same interest rate on a bigger pile of debt costs you far more than the number makes it look. Not because the rate changed, but because you've quietly taken away your own room to bend. And this is true even when nothing goes wrong at all. Because you've already promised that money away, your choices start to shrink. You can't easily leave a job that's grinding you down because the payments won't wait while you find another. You can't take a few months out to retrain or move somewhere better on a hunch. You can't take the lower-paid job you'd actually love, or go part-time while the kids are small, or start the thing you keep meaning to. Picture someone offered their dream job for a bit less money, or the chance to go and study something they've always wanted to. On paper, they can't afford the drop. Not because the new life costs more, but because the old debts still have to be fed. The choice was made for them long ago, when they signed. It also ties you to the life you already have. The payments assume you'll carry on earning what you earn now, so you can't easily take the risk that might not pay off for a while, turn down the extra shift, or let anything rock the boat at work. And when a pay rise finally comes, a good part of it is already spoken for, so earning more doesn't buy the freedom you thought it would. Even having some cash in the bank doesn't fully free you, because you still have to make that payment every month, savings or not. That's the real trade you're making. Debt hands you something nice today in exchange for your choices tomorrow. And you pay that price every ordinary day, not just when something goes wrong. You can see the whole thing most clearly when times get hard for everyone at once. In a downturn, when jobs disappear and money gets tight across the board, it isn't random who gets pushed under. Again and again, it's the households carrying the most debt compared to what they earn. They're the first to fall behind on the payments, and the first to lose the home or be forced to sell. And a house sold in a hurry, in a bad market, goes for less than it's worth, while the debt still has to be cleared out of whatever's left. That's how a manageable problem becomes a lasting one. The shock was coming for everyone on the street. But for the family who owed a lot, it forced a panicked decision at the worst possible moment. For the family who owed little, the same shock was just something to get through. The same event and two completely different endings. And most of the difference came down to how much had already been promised away before it hit. None of this means debt is bad. Borrowing can be sensible, and sometimes it's exactly the right call. But it does mean the interest rate was never the only thing to weigh up. Before you take something on, it's worth asking how much of your future you're promising away, how many of your choices it quietly closes off, and how much harder it would make the next bad year, the one coming whether you want it or not. A cheap loan that leaves you no room can end up costing you far more than its rate ever suggested. The room to move, whatever life throws at you, is the thing worth holding on to.